Welcome to this tax compliance class. My name's Kieran Doe. I'm a senior tutor at ACA Masters and multiple ICAEW prize winner. In this class, I'll be going through the syllabus changes for 2024. So there have been quite a few syllabus changes for 2024. Some are just basic changes in allowances and rates. Others are more significant changes and introductions or removals of certain topics. So firstly, for income tax, the dividend allowance has been decreased to 1,000 per year. So fairly basic change there. And the additional rate band has also been reduced. But these are in the tax tables should you need to look them up. Particularly the additional rate band, I think, is something you would probably look up in the exam. So in terms of employment income, national insurance rates are now 12 and 2% for employees. So they have been reduced in the 2023 exams. The examiners use the increased rates, which were only actually in force in the real world for a short period of time, but they've now reverted back to 12 and 2% in the ICAEW exams. And the 0% band for employees is now in line with the personal allowance for income tax. So that makes things a little bit more straightforward and makes marginal rates of tax a little bit easier to deal with. But these are all covered, and we'll discuss this in detail during the employment income class. So in terms of unincorporated businesses, so sole traders and partners, there's been a welcome simplification of the basis periods rules. Those of you who did the principles of tax exam or have any experience working in tax, working with unincorporated businesses, you'll know that the basis period rules could be very, very complicated at times. So there's been a significant simplification of these rules, which is very much welcomed by people working in tax and also those preparing for their tax exams, where individuals will just be taxed based on the profits arising in the tax year. However, slightly unfortunately for you, perhaps, you're going to need to understand the transition rules, and therefore this can give rise to transition profits, which are taxed over several years. So during the basis periods class, I'll cover this in detail and show you a few shortcut methods you can use for calculating these transition profits. So of course, this calculation of transition profits will only be in the exams in 2024. Probably, possibly could still be included in later exams, but highly likely it will just be included in this year's exams. So the fact that the examiners have brought it in to the syllabus for this year may mean that it is more likely that it will be examined, because this could perhaps be their only chance at examining you on a specific calculation of transition profits. But as I said, we'll cover this in detail during the class and focus on those transitional rules. But then, as I said, these will then feed into the income tax computation, and we'll see that there'll be tax on those profits arising as a result of this transition to a simpler basis. So it's going to be simpler going forward, but unfortunately, you're caught in the transition year. And similar with employees, NI rates have now reverted back to what they were previously. So that's 9 and 2% for unincorporated businesses. But again, we'll discuss that in detail when we're working through the class on unincorporated businesses. So in terms of pension contributions, the annual allowance, the amount that an individual can put into their pension each year, has been increased up to 60,000. Quite a small point there, but important to note that if you were more familiar with the previous 40,000. So for corporation tax, there have been some more substantial changes. So the first one being to the corporation tax rate. So it previously had been at 19%. There is now the 25% corporation tax rate. However, small companies, those with profits 50,000 or below, will still pay at 19%. So companies with profits less than 50,000 will pay at 19%. Those with more than 50,000 will pay at 25%. So these are not tax bands. This isn't the first 50,000 is taxed at 19%, and then all profits after that are taxed at 25%. If a company's got profits more than 50,000, all the profits are taxed at 25%. So this isn't like income tax where you've got the different bands. The first tranche of income is taxed at a certain amount, the next tranche at the next amount. All profits, if they're above 50,000, will be taxed at 25%. So of course, without any other additional provisions, this could cause quite unusual tax rates and tax incentives. Because if you think if we've got a company with profits of 50,000, then we know they're taxed at 19%. But a company with more than 50,000, for example, 51,000, taxed at 25%. So then you think that extra £1,000 of profits is effectively giving rise to an extra 3,250 of tax, which make no sense. As soon as a company got to 50,000 of profits, they wouldn't want to make any more, certainly for in the next kind of relevant range. So, they might shut down for a few days or something like that. So that wouldn't really make any sense because, as I've explained, these aren't tax bands. All the profits are taxed at these amounts. Therefore, we have marginal relief, which if a company has profits between 50,000 and 250,000, then they get marginal relief, which reduces the tax. So the way this works is that companies with profits between 50,000 and 250,000, you calculate the profits at 25%, but then you will calculate marginal relief. And the calculation for this is in the open book, so it is very straightforward. But if we just look at this example here, you start with the upper limit, which of course is the 250,000, as I've just explained. You take the augmented profits, which in this case is the same as the total taxable profits. So this would be different if they were receiving dividend income. And remember, dividend income isn't taxable itself. But if they were receiving dividend income from non-group companies, then that would be included in the augmented profits. But again, you would simply just be applying a formula, so it isn't too difficult. But in this case, we've assumed that they are the same. So you take the upper limit, get the augmented profits, and then multiply by the fraction, which again is given in the open book, straightforward. The whole formula is given in the open book. It really isn't too difficult. And then you can get your marginal relief. And then you can sense check your answer. And you can see if they're just above 50,000, then that should result in the tax rate only just being above 19%. What this marginal relief is doing is really kind of smoothing that jump from 19% up to 25%. So if they're close to 50, the limit to pay everything at 19, then you'd expect the tax rate, the effective tax rate, to be close to 19%. Whereas if they're closer to the 250, then you can see, the marginal relief would be lower. You can see I've just calculated it in exactly the same way. And if we expect the rate to be closer to the 25%, because they're closer to not getting any marginal relief. And once you've got profits of 250,000, it's at 25%, and that's it, no marginal relief. So actually the logic of marginal relief is very straightforward. When you think about it like that, the formula's in the book, so it isn't as complicated as it looks, as we'll see throughout the course. There's lots of areas in tax which seem really complicated, but actually there's a very simple logic to them. And if you understand that, it actually makes understanding the questions and understanding the topics a lot more straightforward. There's also a way when the augmented profits and the taxable profits are the same, you can actually do a shortcut method for calculating the tax liability. Because as I've kind of explained here, what we're really trying to do here is going to smooth, what marginal relief is doing is smoothing this transition from 19 to 25%. So a shortcut method could be, if you've got profits at 51,000, first 50,000 at 19%, and then the next 1,000, the effective tax rate on profits at the marginal rate is 26.5%. So you can see that here. So that can be useful in maybe losses questions if you were calculating it to work out the best use of a loss. But the examiners have made it clear that you shouldn't use a shortcut method when you're asked to calculate the tax liability for a company. You should show the full marginal relief calculation. And what they may possibly do is include augmented profits in there, so it would make this calculation very difficult to do. And not something where a student would get to the right answer with it. So make sure you do take on board the examiner's guidance there. And of course, the same can be done with anything. So this company, this example, profits are 200,000, first 50 at 19, the rest at 26.5, and then you can get the tax liability that way. But only if the total taxable profits and augmented profits are the same, i.e. there's no dividend income from non-group companies. And only in more tax planning questions like best use of a loss. So really in the TC exam, it's going to be more computational, like calculating a tax liability, and therefore you should show your full workings. But like I said, with the marginal relief formula in the book, it really isn't too difficult to do these calculations and pick up what will be some relatively easy marks there in the exam. So there's also some new rules around capital allowances. So full expensing is now in place. So companies can take a full deduction for expenditure on new assets, which would normally go into the main pool, doesn't include cars. So in a way, it's very similar to like the first year allowances we get on very specific assets. So these are on some very specific assets, these first year allowances, things like plant and machinery and enterprise zones, R&D assets, etc. So it is similar to those, other than that they are on specific assets, where this is kind of on all main pool assets except cars. And in a way that's quite similar to the AIA, where you can just deduct the full amount of capital expenditure in the year. So that gives rise to some careful considerations about which relief should you claim on which type of asset. And we'll cover that in detail in the corporation tax class. In addition, the old super deduction, which is being phased out, could also be relevant in your exam if there was capital expenditure on a qualifying asset before the 31st of March 23. And that's obviously more favourable. That was 130%, so more favourable than the 100%. So you could end up in some quite relatively complicated scenarios where you're going to have to think quite carefully about which relief to claim. If the super deduction is eligible, then yes, we would be going for that. So be claiming that in preference to AIA. But if it's after the super deduction date and it's full expensing, then actually AIA would be beneficial because of the way the disposal is treated. So we'll cover that in detail there, as well as the special rate allowance, which continues. So the super deduction is being phased out, but the special rate allowance will continue. So yes, capital allowances are very complicated for exams, or potentially very complicated for exams in 2024. Technically not too complicated. It's just with all of these availability of the relief, some of these stemming back from COVID, and now we've got full expensing in place as well as the AIA, which just requires us to carefully consider which relief we should claim. But when we go through that class, you'll find it all very clear about what to do. And as always, I'll be working through questions so you can see exactly how to think through this in the exam, but they'll be covered in the corporation tax class, as will questions when I'm doing calculations of the tax rate, including marginal relief. So another change for corporation tax is just a change in the R&D rates. So large companies has increased now to 20%, SME additional deduction from trading income only 86%. We'll go through this in detail during the corporation tax relief class, and I'll also explain why these aren't a direct comparison, because the treatment of the large company regime and the SME regime is very different. So intangible assets are no longer examined in TC, which is probably a bit of a surprising removal from TC, particularly because they were only examined at a very basic level, and the treatment is actually very straightforward in that we follow the accounting treatment, but they've been removed, and they've therefore been removed from the questions in the workbook. So be saving that for BPT. CGT annual exemption is in the process of being cut. So see that in CGT, the annual exemption available is now only 6K. That's a very small basic change, really. Where we'll really be focusing more on is what's the best use of the annual exemption, what asset should it be set off against. That's going to interact when we look at reliefs and when we look at the international aspects of CGT as well, but of course important to use the right amount. And then finally, very basic, small one for stamp duty, the residential band, 0% band for residential property has been increased. And similarly, in relation to that, the 0% band for first-time buyers has increased. That's very small. It's quite rare, really, we see questions in the TC exam focused on residential property, just because commercial property makes better questions generally, because we can see the interaction with VAT. So most questions in the TC exam focus on commercial property rather than residential property. And also in the exam, if a question comes up, calculate the stamp duty payable, you're going to go to the open book, and therefore you're going to see the rates in there. So that's not too much of a significant change, because you'd be looking at up in the open book anyway, and the open book for 2024 obviously has the new 2024 rates in it. So a real mixture of updates for 2024, really. A lot of basic ones like changes in allowances and the bands, like the rates. That's all fairly basic, particularly on a lot of areas where you would be looking that up anyway. Probably not the CGT annual exemption, you're going to the exam knowing that, but all of these you'd probably be looking up anyway. And if you haven't covered R&D before, you wouldn't have any other rates in your mind, so that's kind of fine there. I'd say probably the most significant changes are the basis periods rules for unincorporated businesses, and the potential for a question on transitional profits if this is the only year it's going to be included in the exam. Corporation tax rates is a significant change, particularly the reintroduction of a marginal relief. As we expect to see that in the exams in 2024. Definitely there'll be something on basis periods as well, we think. Capital allowances are in the vast majority of questions for corporation tax, and these rules do only apply for companies, not for unincorporated businesses, and we'll cover that in detail during the class. But highly likely that capital allowances for companies will be examined. R&D will very likely to be in there as well. So most significant changes, I would say, around corporation tax with the rates, capital allowance changing, and R&D, and then also the transition profits for the unincorporated businesses. But like I say, all of this will be covered in detail during the respective classes. Of course, it's been fully updated for 2024. And whilst it's very important to make sure you are using the right amounts in the exam, the examiners quite often comment that students may use the wrong rates or not be familiar with new rules. The real key to passing the TC exam is having understood the content, and therefore that's why we teach it in a really simplified, straightforward way, but then also having a really good exam technique. And that's why during every class, I'll be working through lots of questions, so I can demonstrate how you should read and interpret the requirement, how you should analyze the information, how you should use each piece of information in your answer, so that you can then go away and practice producing answers in exactly the same way that I do, so you can also achieve a very high mark in your TC exam. So I very much look forward to working through the course with you and helping you achieve a similar level of success in your TC exam.